Bitcoin's recent rise has led to a flurry of articles citing how it is about to replace gold as a key reserve asset. But in times of extreme uncertainty, I believe that gold remains the ultimate form of insurance in these troubled times. Today we take a look at this argument, so let's dive on in. Now, this channel provides global macro insights and champions the importance of sound money in a world gone crazy, so please do consider subscribing. Gold's historic pedigree over thousands of years is really something to behold. It's easily explained and understood as a premium store of value, but recently the divergence between gold and Bitcoin prices has fueled a huge debate arguing that Bitcoin is the new gold. But as I have discussed previously in this video on riding the gold and silver bull, such declines as we have recently seen for gold are nothing out of the ordinary. Indeed, the last run to 2011 saw pullbacks occurring from May to June of 2006 at 23%, March through to October 2008 of a whopping 35%, February to April 2009 of 14%, November through to February 2010 of 15%, June to July of 2010 of 9%, and two further pullbacks in 2011 before attaining that all-time high in September of that year. And so let's explore four key reasons why gold is the ultimate form of insurance. First, and perhaps most importantly for those speculating on the gold price, is that gold is a cyclical juggernaut when monetary policy becomes deeply questionable. We saw this in the gold bull runs through to 1980 and again in 2011, offering gold holders significant returns. And so gold has a high degree of sensitivity to central bank balance sheet expansion, but it also has a direct correlation to real interest rates, as we can see in this chart. Yet in the midst of a massive monetary policy bubble that is set to grow ever greater as bank balance sheets soar and interest rates go negative, while deficits and debt gap ever wider, gold remains the ultimate tangible insurance. Second is the fact that fiat currency is the ultimate Ponzi scheme, where economic growth remains dependent upon ever more debt, ever more fuel for the fire. But all of this debt is deflationary, and deflation is a massive threat to an over-indebted, over-leveraged system, for it increases the real size of the debts and interest payments on that debt. Too much deflation leads to the implosion of the entire Ponzi scheme system. So to offset this, inflation must be stirred, and the obvious means by which this inflation can be generated is via the coming world of CBDCs, MMT, and further expansion of balance sheets and national debts. And so what will happen to the value of fiat currencies in the face of such debasement? Well, I believe gold will tell us the answer to that one, as it has done throughout history. Third, while Bitcoin has enjoyed tremendous gains recently and since its inception, it is an effective 12-year-old with enormous potential. Unquestionably, exposure to the asset has enhanced investment portfolios over this period. And the recent softening of the gold price certainly seems to have come from asset rotation away from paper gold towards Bitcoin. And as we can see in this chart, which shows the largest ever gold ETF outflows at a time where crypto markets were soaring and the Dow went over 30,000. But trading ETF gold with stop losses remains a very different beast from that of buying and holding physical gold as a form of long-term insurance and wealth preservation. And so gold will always act to preserve wealth during times of fiat currency debasement. The breadth and depth of gold markets enables gold to maintain ample liquidity even in times of crisis. Gold's market size at around $9 trillion or so also offers a high degree of stability against smaller markets, whether it be silver or Bitcoin, which can therefore be that much more volatile. Gold therefore offers stability. It is bedrock to an investment portfolio where many will retain an allocation to gold simply for insurance purposes, even as we enter a new risk-on period. And so in doing so, it enhances the stability of investment portfolios, as we've discussed previously. And so now, as chief economists at central banks warn of higher future inflation, gold, and for that matter, silver, are my hedges of choice. And while some argue Bitcoin is the most superior savings technology, and I certainly love the mathematical design of the asset, it does fail to actually satisfy the trust test for many people. In particular, in that it is simply not a tangible asset, rather it is simply digits on a screen. Another contrarian perspective that I often hear is that what this crypto experiment looks like to me is a deep state trial balloon that paves the way for a global SDR that will invariably be the globalist status crypto SDR of a brave new cashless world. But I would counter such points by looking at the facts that one thing the so-called deep state have never ever wanted people to question in a world flooded with paper money is the notion of what truly constitutes money. Unquestionably, cryptocurrencies have played a highly significant role in educating a new generation on the principle of sound money. In my view, this is the last thing central bankers would ever have wanted. Thus, it seems entirely conceivable to me that crypto assets such as Bitcoin will continue to play an increasing role in the new monetary world order and will realize some of the largest gains, given that even the market cap of Bitcoin is dwarfed by that of gold. Yet this will also give rise to much greater volatility, such as we have already seen with Bitcoin falling around 10% from its recent highs. Fourth, what asset continues to be hoarded by our monetary masters? An asset they deliberately seek to manage the value of? Well, of course, it remains gold. Yes, they manipulate the market, but this has not stopped gold from attaining dramatic gains against the stock market over the last 20 years. What's more is that all markets are manipulated. Just look at the stock market's gains guided by the not so invisible hand of the Fed, or the impact of whales in the crypto market, or even worse, the foreign exchange markets. But should there ever be a rush to physical assets, the paper, gold, silver scheme breaks down. And so holding physical gold or silver is the safest form of asset class for all eventualities, including the notion of a cyber pandemic. And few central banks will contemplate selling their gold due to the integrity and confidence that it offers them. Gold represents power, and he who owns the gold makes the rules, as the saying goes. And so for those with diversified investment portfolios, gold price fluctuations will always happen as markets undertake asset rotation. But as Simon Mikhailovich emphasizes in this recent tweet, gold, and silver for that matter, is the only financial asset inherently independent from the system. How valuable is this attribute to those who have never experienced systemic failure and do not believe it can ever happen to them? Not very much. People never put high value on freedom until they lose it. And of course, gold is money of the free. And so these are my reasons for always ensuring we have a firm bedrock of gold within our portfolio. But in a world with an ultra dovish Fed, the potential tag team of Biden and Yellen, soaring central bank balance sheets, record stimulus, gold has a significant role to play. Is there a risk of confiscation? Absolutely. In time, and with the notion of this neo-Marxist Great Reset, yes, clearly. But there remains easier targets. And confiscation is more in line with nationalisation, where you will actually be given some fiat in exchange for such assets. But the prospect of this remains some way off yet. Personally, I like to hold both gold and Bitcoin. The Bitcoin certainly helps me to realize greater returns on my investment, but the gold provides me with that ultimate stability. And when it comes to silver, well, you know, I've said it before, gold for stability, silver for gains. What do you think? Do let me know what you think in the comments below, and I'll look forward to seeing you next time. Bye bye.